If I gave you a choice between making your first $100,000 or making your next $900,000, which would you choose? Most people instinctively pick the first option. After all, $100,000 sounds a lot easier than nearly $1 million. But ask someone who has already built wealth, and you'll often get the exact opposite answer. Almost every millionaire would choose the next $900,000 without hesitation, because the first $100,000 is usually the hardest money they ever make. Not because investing is complicated, not because the stock market is rigged, and not because they suddenly became financial geniuses after reaching six figures. Something else changes. In the beginning, building wealth feels like pushing a car uphill with your bare hands. You save every month, invest consistently, avoid mistakes, and then check your account a year later, only to discover that most of the growth came from your paycheck, not your investments. It feels slow. Sometimes it feels broken, and that feeling causes countless people to quit at exactly the wrong moment, because eventually the hill disappears. The same habits that once felt painfully unrewarding suddenly start producing results that seem almost unfair. So, what changes between those two stages? Why does money appear to move in slow motion at first and then suddenly begin accelerating on its own? By the end of this video, you'll understand exactly why the first $100,000 feels so difficult, why most people never make it there, and why the people who do often find that the next chapter becomes dramatically easier. The beginning of investing feels strangely disappointing. Most people expect that once they start saving and investing, they will finally feel their money beginning to work for them. They imagine opening their account every few months and seeing clear evidence that they are moving forward. After all, if investing is supposed to be the engine of wealth, the engine should feel powerful from the start. Instead, it often feels like nothing is happening at all. You save a few $100s this month. Then you do it again next month. You stay disciplined while friends spend freely, upgrade their cars, or book vacations you quietly decide to postpone. Month after month, you continue sending money into an account that seems to move far more slowly than you expected. Then comes the moment almost every investor experiences. You open your portfolio after an entire year of consistency and realize that most of the growth didn't come from the market at all. It came from you. Your paycheck contributed thousands of dollars while your investments may have added only a few hundred in returns. The effort feels completely out of proportion to the reward. This is where doubt begins to creep in. Maybe investing only works for people who already have money. Maybe those stories about wealth multiplying on its own are exaggerated. Maybe you're simply too late to the game. But the truth is much simpler. Nothing is wrong. The market isn't failing you. Your investments are doing exactly what they are supposed to do. Expecting a small portfolio to create life-changing returns is like expecting a single employee to run an entire company alone. No matter how hard that employee works, there is only so much they can produce. And that is what makes the first stage of wealth building so brutal. The rewards are almost invisible at exactly the moment when your discipline matters the most. The strange thing about compounding is that it works exactly as advertised and still manages to disappoint almost everyone in the beginning. The problem isn't the math. The problem is that our brains expect effort and reward to arrive at roughly the same time. Work hard for a week and you get paid at the end of the week. Study for an exam and your grades arrive a few days later. Go to the gym for a few months and eventually you start noticing changes in the mirror. Investing doesn't follow those rules. For years, compounding feels almost invisible. You keep adding money, keep waiting, and keep expecting the process to speed up. Instead, the progress seems painfully small. The first $1,000 feels difficult. The first 10,000 feels even harder. Reaching 50,000 can feel like climbing a mountain that somehow keeps getting taller as you approach it. This is where many investors begin to believe the system is broken. But compounding was never designed to reward impatience. Imagine planting a tree and digging it up every few weeks to check whether the roots are growing. From the surface, nothing appears to be happening. Underground, however, an entire system is quietly forming that will eventually support something much larger. Money behaves in a surprisingly similar way. For a long time, the curve looks almost flat. Then one day, it starts bending upward so aggressively that it almost looks like a mistake on the chart. The years that once felt insignificant suddenly become the foundation for everything that follows. And this reveals an even bigger truth about the first $100,000. During most of that journey, your investments aren't actually doing the heavy lifting at all. One of the biggest misconceptions about investing is that the stock market starts building your wealth from day one. In reality, for most of the journey to the first $100,000, your portfolio is not the hero of the story. You are. Your job, your discipline, and your ability to keep saving month after month are doing almost all of the heavy lifting. The investments are helping, but they are sitting quietly in the background while your paycheck carries the entire operation. Imagine someone investing $1,000 every month with a portfolio worth $15,000. Even if the market delivers an excellent year and grows by 10%, the portfolio only produces about $1,500 in gains over the entire year. Meanwhile, the investor personally contributed $12,000 from their salary during that same period. The market helped, but the investor did almost 8 times more work than the portfolio did. This is why so many new investors become obsessed with the wrong things. They spend hours searching for the perfect stock, worrying about whether one index fund will outperform another, or trying to predict where the market will go next year. It feels productive because investing decisions seem more exciting than budgeting decisions. But at this stage, finding an extra $200 to invest each month often has a far bigger impact than squeezing out an extra 1 or 2% in returns. The uncomfortable truth is that wealth building begins as a behavior problem long before it becomes an investing problem. Your income matters. Your savings rate matters. Your ability to avoid upgrading your lifestyle every time you receive a raise matters even more. Before your investments can work for you, you have to work for your investments. But this is not a permanent arrangement. Eventually, there comes a point where your money starts showing up to work alongside you. Then, slowly, and almost without warning, your investments stop riding in the passenger seat and quietly reach for the steering wheel themselves. For years, building wealth feels like carrying a heavy cart uphill. Every dollar that moves your portfolio forward comes from your effort, your paycheck, and your discipline. You save money, invest it, and repeat the process month after month. The market helps a little along the way, but it never feels like the powerful wealth-building machine everyone talks about. Then one day, something strange happens. You open your account at the end of the year and realize your investments made more money than you did. Not more money than your salary, of course, but more money than you personally added to the portfolio that year. For many investors, this is the moment everything changes. Imagine investing $1,000 every month. Over the course of a year, you contribute $12,000 from your own pocket. If your portfolio has grown to $200,000 and the market delivers a fairly normal 10% return, your investments generate around $20,000 without requiring a single extra hour at work, a single overtime shift, or a single difficult conversation with your boss. For the first time, your money contributed more than you did. This is the moment many investors describe as financial escape velocity. A rocket uses almost all of its fuel during launch because escaping gravity requires enormous effort at the beginning. Once it reaches a certain speed, however, staying in motion requires far less energy than getting started in the first place. Money behaves in a surprisingly similar way. The early years require almost constant pushing. Then, eventually, the system begins helping you push back. Market movements that once felt insignificant suddenly become larger than entire years of contributions from your paycheck. A good year in the market can create more wealth than months of work ever could. This is why wealthy investors often seem to move faster than everyone else. They aren't necessarily working harder. They simply have thousands of financial employees working alongside them every single day. Unfortunately, most people never experience this moment. Not because they were incapable of reaching it, but because they walked away during the years when progress still felt invisible. One of the cruelest parts of building wealth is that the moment people feel most discouraged is often the moment they are closest to something important happening. After years of saving, investing, and watching painfully slow progress, many investors reach a point where the entire process starts to feel pointless. They look at the sacrifices they made, the purchases they postponed, and the discipline they maintained, and they begin asking themselves a dangerous question. Is this really worth it? From their perspective, the answer often appears to be no. They did what the books told them to do. They invested consistently. They stayed patient. They ignored the noise and trusted the process. Yet, after years of effort, the results still seem far smaller than they imagined when they first started. The rewards feel delayed, the progress feels invisible, and the excitement that existed in the beginning slowly turns into frustration. The problem is that compounding creates one of the biggest psychological traps in all of finance. Human beings are naturally designed to respond to immediate rewards. If you study harder, you expect better grades. If you work more hours, you expect a larger paycheck. If you practice a skill every day, you expect to see yourself improving. Investing breaks that relationship completely. The biggest rewards often arrive long after the hardest work has already been done. Imagine spending years digging for gold with no guarantee that anything is waiting below the surface. Every day requires effort, but every day looks exactly like the one before it. Eventually, most people stop digging not because they are lazy, but because they become convinced that there was never any gold there to begin with. Compounding creates the exact same experience. The painful irony is that many investors quit during the stage where patience is about to become profitable. They mistake silence for failure and slow progress for no progress at all. The curve that eventually creates extraordinary results often starts bending upward just after most people have already walked away. And that is exactly why reaching the first $100,000 is less of a mathematical challenge than a psychological one. The people who eventually build wealth are rarely the people who discovered a secret strategy. More often, they are simply the people who stayed long enough to let the strategy finally start working. The good news is that while you cannot cheat compounding, you can shorten the painful phase that comes before it. Most people assume the answer is finding better investments. They spend years searching for the perfect stock, the next great company, or a strategy that can beat the market by a few extra percentage points. The reality is far less exciting and far more powerful. During the race to the first $100,000, your savings rate usually matters far more than your investment returns. An investor who saves aggressively in an average index fund often reaches the finish line faster than someone chasing spectacular returns with inconsistent contributions. That is why increasing your savings rate is so powerful. Every extra dollar invested today is another employee you hire to work for you for the next 20 or 30 years. Cutting one unnecessary expense may not feel life-changing in the moment, but giving that money decades to compound can completely change its future value. Increasing income can accelerate the process even more. A raise, a promotion, a better career opportunity, or a side business can dramatically reduce the time it takes to reach financial escape velocity. The mistake many people make, however, is allowing their lifestyle to rise at the same speed as their income. A bigger paycheck feels like progress, but if every raise immediately turns into a bigger house payment, a more expensive car, or higher monthly expenses, the finish line never gets any closer. Consistency matters just as much as the amount itself. Markets rise and fall, headlines become scary, And every few years, someone confidently announces that investing no longer works. The investors who eventually benefit from compounding are usually the ones who continued buying during the boring years, the uncertain years, and the uncomfortable years when quitting felt reasonable, because the goal was never to get rich quickly. The goal was to survive long enough to reach the stage where your money finally starts helping you carry the weight. And once that happens, everything begins moving faster than you ever thought possible. The first $100,000 isn't difficult because investing is complicated. It isn't difficult because wealthy people know secrets that ordinary investors don't. And it certainly isn't difficult because the math is working against you. The first $100,000 is difficult because for years the rewards remain almost invisible. You do the work, make the sacrifices, stay consistent, and yet the results often feel far smaller than the effort you're putting in. The process asks for patience long before it offers proof. That is the real test. Most people don't fail because they picked the wrong investment. They fail because they mistake slow progress for no progress. They assume the machine isn't working when in reality the machine is still warming up. Compounding has a strange personality. At first it whispers. Then it speaks. Eventually it starts shouting. The tragedy is that most people leave the room while it is still whispering. The investors who eventually build wealth are often not the smartest people in the market or the people who discovered some hidden strategy before everyone else. More often, they are simply the people who stayed long enough to watch the curve finally bend in their favor. Because the first $100,000 is not just a financial milestone, it's a psychological milestone. For years, it feels like you are carrying your investments uphill on your back. Then one day you look around and realize something has changed. Your investments have started carrying you, and that is the moment the game becomes completely different.